Everyone is staring at silver's price right now. Every chart, every candle, every headline asking whether it's about to break out or break down. But that's not where the real move just happened. Because the most important thing in the silver market this week had nothing to do with price at all. It happened quietly, off the screen, in a place most retail investors never look. And if you missed it, you're already behind. Silver didn't signal its next move by going up or down. It signaled it by changing hands, by delivery. And not just any delivery, the kind that tells you who is preparing for what comes next. For most people, silver is just a ticker, a line on a chart, something that moves when the dollar weakens or inflation spikes. But for institutions, silver is not a trade. It's a position, a hedge, a supply chain asset. And when those players stop rolling contracts and start taking delivery instead, it means the game has shifted. This is the part of the market most people never see. Futures prices get the attention. Headlines get the clicks. But delivery is where intent shows up. Because you don't take delivery of physical silver unless you need it, or you don't trust that it will be available later at the same price, under the same conditions. And that's exactly what just changed. Over the last several sessions, while retail traders argued over resistance levels and moving averages, large blocks of silver were quietly removed from registered supply. Not transferred, not reshuffled, removed, claimed, taken out of the system. And once silver leaves registered inventory, it doesn't behave like paper silver anymore. It stops being liquid. It stops being flexible. It becomes something you have to replace. That matters more than any single price scandal. Because silver is not like stocks. You can't just print more. You can't just settle everything in cash forever without consequences. At some point, someone has to deliver metal. And when more people want delivery than expected, the system doesn't break all at once. It tightens first. It gets stressed. Small delays, higher premiums, subtle rule changes, margin adjustments, and then suddenly, everyone realizes the market they thought was liquid isn't. This is why delivery matters. What's happening now is not a panic move. It's not retail piling in. It's not social media hype. It's positioning, quiet, deliberate positioning, the kind that usually happens before volatility, not after it. And here's the part most people don't understand. When silver is taken for delivery at scale, it creates a delayed effect. Prices don't explode immediately. In fact, they often stall. They confuse people. They make holders doubt themselves. They make traders think nothing is happening. That's by design, because the people taking delivery don't want attention. They want time. Time to secure supply. Time to reposition exposure. Time to let weaker hands get shaken out. Time to let narratives flip back and forth while the underlying market structure changes underneath. This is why so many silver moves feel wrong in the moment. Price goes nowhere, or even drops, while fundamentals quietly tighten, while inventory thins, while demand shifts from speculative to physical. And that's where we are right now. Look at the structure of this market. Paper silver still trades freely. Contracts roll, volume prints. Everything looks normal on the surface, but beneath that surface, the balance between paper claims and physical availability is being tested again. Not dramatically, not yet, but noticeably enough for the people who actually operate in this space to act. And they did. The mistake most retail investors make is assuming price leads fundamentals. In commodities, especially silver, it's often the opposite. Fundamentals move first. Price reacts later, sometimes much later. And in between, there's confusion. That confusion is the trap. Because when price doesn't move the way people expect, they abandon positions. They lose patience. They assume the thesis was wrong. They stop paying attention. Meanwhile, the people who understand delivery don't care what price does this week. They care about availability 3 months from now, 6 months from now. And that's the time frame that matters here. Silver is a small market, much smaller than most people realize. It doesn't take massive demand to change its dynamics. It just takes consistent demand in the wrong place. And delivery demand is the wrong place for the system, because delivery demand forces the system to perform. It forces metal to show up. It forces inventories to shrink, and it exposes how much of the market is built on assumption rather than reality. This isn't new. We've seen versions of this before. Periods where delivery quietly increased. Periods where registered inventories bled slowly. Periods where price lagged and sentiment collapsed. And then suddenly, price caught up all at once. Not gradually, violently. But here's the key difference this time. The macro backdrop is completely different. Interest rates are no longer falling from zero. Governments are more leveraged, not less. Supply chains are tighter. Energy costs are higher. Geopolitical risk is everywhere, and trust in paper promises is weaker than it's been in years. That changes how delivery is interpreted. In a stable system, delivery is just logistics. In a stress system, delivery is a signal. And right now, the system is stressed. Not collapsing, not breaking, but stretched. Which is why the players who understand silver are not chasing price. They're securing metal. This is also why you're seeing such a disconnect between headlines and behavior. Public narratives swing wildly. Bullish one day, bearish the next. But delivery doesn't swing like that. Delivery is binary. You either take the metal or you don't. And someone just did. That tells you something important. It tells you that at least one large participant believes silver will be harder to source later than it is today, or more expensive to replace, or both. And when that belief spreads, it doesn't spread through headlines. It spreads through inventory. This is how silver moves before it moves. The market doesn't announce it. It doesn't warn you. It doesn't ring a bell. It lets you get distracted by price noise while the real shift happens quietly underneath. Most people won't notice this until much later, until premiums widen, until delivery times stretch, until price suddenly jumps without a clear catalyst. And then everyone will ask the same question. How did this happen? The answer will be simple. It already did. What makes this phase especially dangerous for most investors is that it looks boring. It looks inconclusive. It looks like nothing is happening. And markets are very good at punishing people during moments that feel uneventful. Because boredom creates doubt. Doubt creates mistakes. Right now, silver is doing exactly what it does before major dislocations. It's refusing to confirm anyone's expectations. Bulls are frustrated because price hasn't exploded. Bears are frustrated because the downside keeps stalling. Traders are chopped up. Commentators argue endlessly. And underneath all of that noise, the structure of the market keeps tightening. This is how positioning works when the stakes are high. No one rings a bell. No one announces a shortage. No one tells you supply is being locked up. They simply remove metal from circulation and let time do the rest. And time is the one thing most retail participants don't have, because retail trades price. Institutions trade access. Access to liquidity, access to inventory, access to delivery when others can't get it. And that's the difference between trading silver and owning it. One is a bet on movement. The other is a bet on scarcity. This is why delivery matters so much more than sentiment. Sentiment flips instantly. Delivery does not. Once metal is taken out of registered supply, it doesn't magically come back because price moved $1 or $2. It stays out. It becomes spoken for. It becomes unavailable to someone else who might suddenly need it later. And that's how pressure builds without anyone noticing. The most misunderstood part of silver is how small the margin for error really is. The market functions smoothly only as long as most participants agree not to test it, as long as most people roll contracts instead of standing for delivery, as long as cash settlement remains the default expectation. The moment that expectation shifts, even slightly, the system starts to feel it. And that shift doesn't start with panic. It starts with preference. A preference to hold metal instead of promises. A preference to remove counterparty risk. A preference to secure supply in advance rather than compete for it later. Those preferences are forming now. This is why focusing only on price is misleading. Price is the last thing to react. Availability reacts first. Logistics reacts second. Premiums react third. And price reacts last. By the time price makes sense to everyone, the opportunity is already gone. This is also why silver moves are often violent and compressed. The market spends a long time pretending nothing is wrong, and then suddenly corrects all at once, not because something new happened, but because something old finally mattered. And when that happens, it doesn't reward patience equally. It rewards positioning. This is where many silver holders make their biggest mistake. They assume that because price hasn't moved yet, nothing has changed. They wait for confirmation. They wait for headlines. They wait for validation. And by the time it arrives, the market has already repriced. Confirmation is expensive. The people who understand this aren't loud about it. They're not posting screenshots. They're not predicting exact price targets. They're not counting days. They're watching flows, watching inventory, watching behavior. Because behavior never lies. And the behavior we're seeing right now is not speculative. It's defensive. It's deliberate. It's long-term. This doesn't mean silver goes straight up tomorrow. That's not how this works. In fact, one of the most likely scenarios from here is continued frustration, continued sideways movement, continued attempts to shake confidence, continued narratives designed to exhaust attention. Markets don't just move prices, they move psychology. And silver is exceptionally good at breaking conviction before rewarding it. This is why so many people who were right about silver in the long term still lose money in the short term. They get the direction right, but the timing wrong. They enter emotionally, they exit emotionally, and they mistake noise for signal. Delivery is not noise. Delivery is one of the few signals in this market that cannot be faked forever. You can spoof price. You can flood paper contracts. You can manage narratives. But you cannot endlessly promise metal you don't intend to deliver without consequences. Those consequences don't show up on a chart at first. They show up in behavior, in preferences, in quiet decisions made far from retail screens. And that's why this moment matters. Not because silver is at a certain price, not because a line on a chart was crossed, but because the balance between paper and physical is shifting again, slowly, unevenly, quietly. And once that balance tips too far, the market doesn't ease into a new equilibrium. It snaps. When that snap happens, it won't ask whether you were emotionally ready. It won't care whether you were waiting for confirmation. It won't pause to let everyone reposition. It will simply reprice. That repricing doesn't happen because silver is suddenly discovered. It happens because silver was mispriced relative to its availability. And the moment that reality becomes unavoidable, the adjustment is fast. This is why the people who understand silver don't argue about daily moves. They prepare for structural ones. They know that markets spend far more time building pressure than releasing it. And when they release it, they do so in ways that feel unfair to anyone who wasn't positioned beforehand. That's not manipulation. That's structure. And structure is exactly what just changed. The biggest mistake you can make right now is thinking this story is about being bullish or bearish. It's not. It's about understanding what kind of market you're in. A market where price is still pretending to be in control, while availability is quietly becoming the real driver. That doesn't mean everyone wins. It means the gap between those who understand the system and those who don't is about to widen. Some people will be shaken out before anything happens. Others will chase after it's already moved, and a small group will simply watch, having positioned themselves earlier when it felt uncomfortable to do so. That's how silver always plays out. Not with excitement at the beginning, but with confusion. Not with clarity, but with doubt. Not with celebration, but with silence. And by the time the silence breaks, the story everyone tells will be about price. But the real story will have already happened. It happened when silver changed hands. It happened when delivery mattered more than headlines. And it happened while most people were watching the wrong thing.